Welcome to the Business Concern podcast. My name is Rick Rebusel, and I'm the principal consultant of Business Transition Consulting. My guest today is Chris Mercer, a self-described businessman and valuation guy. Chris is founder and CEO of Mercer Capital, a leading national business appraisal and financial advisory firm. And the topic for today is understanding private company valuation as a concept for building wealth. Welcome, Chris, and thanks for being here.
Well, thanks, Rick. I'm delighted to be here with you. I'm enjoying talking with you already.
You've done a lot of writing, Chris, and I want to start by mentioning two of your books, Unlocking Private Company Wealth and Buy-Sell Agreements for Closely Held and Family Business Owners. And I definitely want to say, there we go. I definitely want to say that if someone is interested in what the topic we're discussing and wants to get a little bit deeper than we can possibly do within the framework of this discussion, I can't recommend any better resources than those two books. Chris, tell us how people can contact you and how they can get a hold of the books.
Rick, I'm available always at mercercapital.com, Mercer C at mercercapital.com, or just go to the website and you can find me. I also have a blog, chrismercer.net, and the books that you mentioned are available on either the website or the blog.
I'm always interested in how people got to where they are now. And can you tell us just a little bit about your background, your hometown, and some of the things that led you to where you are now?
Sure. Well, I was born in Daytona Beach, Florida. I've said jokingly that I'm one of only 3 or 4 people from there because most people in Daytona came there at some point in time. But I grew up in the 50s and early 60s and really enjoyed living in a small town, Daytona. It's a much bigger, busier place today. I went from Daytona Beach, Florida, over to DeLand, Florida, to go to school at Stetson University, and was graduated from there in 19. And
What was that?
I went from there to graduate school and at Vanderbilt University in Nashville, Tennessee. Left there with a master's in economics, and from Vanderbilt, I spent almost 4 years with the United States Army, most of which was in Germany. As I say, I served on that frontier of freedom. I fortunately, I guess I'm a Vietnam era veteran, but I did not go to Vietnam. But it got scary enough in West Germany from time to time. But I went to work at a bank when I came back to the United States in Memphis, Tennessee, called First Tennessee Bank, and thought that, and we became the bank analyst at Morgan Keegan and Company, a small investment banking firm at the back at that time, and started my valuation career really at Morgan Keegan. I sold my first valuation assignment within a month of being at Morgan Keegan, and I was kind of hooked. So I ended up having to do all of the valuations that were done. Was there for 3 years and 3.5 years, and in mid '82, I said, well, it's time to start on my own, and I'd save a little money, and I knew that I wouldn't, crater in a short period of time. I had the ability to stay in business and had some people that I thought would do business with me. So we started Mercer Capital. I started Mercer Capital in 1982. And as I say, I have not been gainfully employed since. Mercer Capital is we're a business valuation and financial advisory firm. We now have, I think, 45 people. We have offices here in Memphis, the biggest office, Nashville, Houston, and Dallas. So it's turned into it's turned into a nice business. But here we are.
Well, it's an interesting story, and I'm glad you're here because one of the things that I deal with quite a bit when I work with businesses is trying to help people understand the relationship between the value of their business and ultimate wealth they may get out of that business, and how to do some planning around that. And so, where I'd like to start is just to ask you the broad question: what's the relationship of private company value to personal wealth?
Well, Rick, in a lot of private companies, most of the wealth that private company owners have is tied up in their business. I have long advocated or suggested to people that if the business is profitable, that you make distributions and create wealth outside of the business. I mean, you can take a small business that doesn't have a great deal of value, that makes a few $100,000 a year, and if you live on a reasonable basis and transfer value into investments, create a nice retirement. On the other hand, if you create a business that has substantial value, then the question is, how do you realize that value, and when do you realize that value? One of those books, Unlocking Private Company Wealth, talks about some ways that business owners can get money out of the business without selling the business, for example, to attempt to diversify. And I like, a lot of our clients have 80, 90, almost 100% of their wealth tied up in their closely held business. And that's not a very good position to be. We're in week 5 of basically lockdown with coronavirus. And if all of your wealth is tied up in a business, in a restaurant business, for example, you might be hurting right now because things happen. Risks. I mean, the world is full of risks, and what I say to people is, take action when you can to diversify, to de-risk your business, to get your business ready for sale. And I don't mean you have to sell it, but one of the things we might talk about is my concept of ready for sale. But a company that is ready for sale is a whole lot more fun to work in than one that's not. And
there really is a difference between what you might call business risk and investment risk. Although the investors aren't doing real well right now, but certainly I think it's safe to say that the risk to losing capital that's invested personally in investments, as opposed to the risk of capital invested in a business, is a different risk.
well, yes, and I mean, life is full of risks. As I say about companies, life is full of one non-recurring risk after another, and the coronavirus is just one of those things. It's unprecedented. I've never seen anything quite like this, and we have been encouraging people to use this as a planning opportunity. When if the value of the value of the markets are down, then correspondingly the value of closely held businesses will be down. And now might be a good time to do some of the planning that people are always or almost always putting off until another day.
Well, there's no question that there's a difference in the risk between the business and a personal investment. But many people, when they look at the value of their business, get confused. And tell us a little bit about the different concepts of valuation and why it is confusing.
Well, let's just start with just kind of the basics of value. The value of a business is the present value of all of the future benefits from the business into the indefinite future, discounted to the present at a risk-adjusted discount rate. And that's the basic discounted cash flow model. And basically, um, every time that we look at any valuation situation, we're looking at risk, cash flow, and the growth of those cash flows. So when I talk about value, I'm always talking about risk. I call it the valuation triumvirate: cash flow and growth. And every business owner ought to be cognizant of risk and looking at the business from the viewpoint of risk. For example, in 2001 at Mercer Capital, we were heavily dependent on the gift and estate tax business. When President Bush uh, signed the estate tax repeal in 2001, half of our business disappeared just like that. I mean, in a day, literally. 25% of our business disappeared. And we've never been as concentrated in anything since. But that's a personal observation that risk is real. I mean, the coronavirus today is real, and it's having an impact on businesses everywhere.
Now, the formula you just gave us, which amounts to basically discounting future benefits to present value, that formula doesn't consider the marketplace or the position of the person that's looking at the business. Now, how does that enter into your valuation activities?
Well, let's consider the concept of fair market value for a minute. It's a hypothetical construct, but it's kind of a term that we use in valuation all the time. And fair market value is a hypothetical price at which a hypothetical buyer or willing buyers and hypothetical willing sellers are looking at the same set of valuation facts. They're looking at the same cash flow, risk, and growth. And what what in fair market value occurs at the intersection of those concepts of the buyer and the seller. In the real live marketplace, um, market transactions occur at the intersection where buyers and sellers can agree on price and terms. So the buyer and the seller are flip sides of the same thing. I mean, buyers always want a low price, and sellers always want a high price. But if you're looking at the same set of facts and you're looking at them objectively and reasonably, I mean, there is a range within which value can, a fair market value or market value can occur.
Now, that example is based on two, I assume, relatively sophisticated entities, a buyer and a seller, fully informed with motivation and in somewhat isolated or independent positions. But what if the two parties are, say, two owners of a business and one wants to buy the other out? How does that change things?
Well, they're looking at the same things. I mean, the buyer is looking at the expectation of future benefits from the business, and he's got to be convinced, he or she's got to be convinced that those benefits are going to be there. And the seller, on the other hand, has got to convince the buyer that you can buy this thing and it's not a pig in a poke. You can buy this thing and you can generate these earnings without me. And so all you have to do is trust me on that. But anyway, they have to come together in some fashion, and the buyer's going to want some protection, that the seller is not going to compete with him or is going to help him for a period of time or do those things that are necessary to transfer the operations and the relationships of the business to the seller. I mean, to the buyer.
There are some differences, though, when you have a one owner buying from another owner, those things that are intangible, knowledge about the business, things that we often put into the category called goodwill, and also the fact that the two owners have other options. They can look at, say, a less successful competitor and say, well, I've got to compare that to what I might be doing here and the valuation then is a comparison as well. So those elements do enter into it, don't they?
They do. I mean, valuation is inherently an alternative investment concept. In other words, the owner that you're talking about that's buying something is looking at this as this company that he's looking at, as opposed to another company. And between those companies, it's the relative value of those companies, the relative benefits of those companies. He'll make a choice, and those comparisons, those comparative valuation issues, will determine what he's willing to do.
You're going to hate this because it's so imprecise in general, but I'm often trying to tell people just to help them with this concept that a fellow owner is not going to pay for what that owner already knows. In other words, the goodwill and some of the things about the clients and some other things, that will lower the value as far as that owner goes. But an unrelated third party who is able to buy the business and not have the present management be integral to the business is going to value the business more than if, say, the owners were involved with the business and integral to the business. So all those elements of they're general elements, but they affect the formula from the position of the people analyzing your mathematical formula.
Well, they do, and I mean, it's been said that valuation is as much an art as a science, and but there is some science to it. There is some art to it as well. But to get it, I mean, the buyer, your hypothetical buyer here, it'll depend on his motivation, really, as to whether or not this similar company is a good target for him or not. I mean, if he's determined to grow and to grow by acquisition, then maybe he'll pay up to get it. So to encourage the guy not to go to somebody else. But all of those, fair market value is no compulsion. In the real world, everybody's always compelled one way or another. You're compelled to do something, you want to do something, you're feeling pressure to do something, but and those relative compulsions also affect price in market transactions.
Chris, if I'm a hypothetical business owner and I'm talking to you and I'm looking at my financial statement and my balance sheet, and I say, I've been running this business for 10 years and I know what it's worth. I know what I own. I know what my income coming in. You're trying to tell me that I should know my value, but I know my value. I know my value better than anybody else.
Rick,
So
Rick,
why do I need to have additional information?
Rick, I'll tell you this. The What a business owner thinks his business is worth is irrelevant, because if he's going to be involved in gift or estate tax transfers, the only value that matters is the value that I or another qualified business appraiser puts on the stock so that he can do something. In a non-gifting context, just every other day, the only thing that matters is what a willing buyer will pay, and that changes over time, as you know, in the marketplace with the availability of financing and what's going on in the economy. So you can have an idea that your business is worth $1 million or $20 million, but it's really irrelevant unless you're trying to do something. If you have a business that's generating substantial cash flow and you don't want to sell it, then maybe we'll value it. Maybe we'll let you sell some stock back to the company, or maybe you can buy stock from somebody and provide liquidity for them and increase your ownership position in the company. But all of those things are possible during that interim time between when you're doing gift and estate tax work and when you put it on the market. But like I say, what that hypothetical owner thinks his business is worth is essentially irrelevant, and it will only mislead him and into not taking action when it's appropriate.
One of the things I tell business owners is that they they need to get an objective view of their business, a different set of eyes. They don't really, because they're involved in the business, because in many times it's their alter ego. And it's very difficult for them to step aside and look at it objectively and make some sort of a judgment about the business. And if if a valuation does nothing more than that, then it's quite helpful.
Well, you talked a minute ago about wealth outside of the business subject to market risk. One thing about that kind of investment is that every day, every month, every quarter, you get a statement from whoever is holding those funds. And you get some indication of what the rate of return of those investments has been. What's been the rate of return on the investment in that private business? The owner may not know at all. And the owner may think, I'm making $800,000 a year out of this business. And so therefore it's worth a multiple of 5. So it's worth $400,000. Well, the problem is uh, he's, he's confusing the return for his effort and the return on his investment. And so only when we make a differentiation between the return on effort, in other words, a salary adjustment, do we get a return on investment. And that return on investment will be smaller in relatively small companies uh, than, uh, than owners are thinking that their company is worth. And that's why one reason why so many business owners overvalue their companies and miss opportunities to sell when opportunities come along.
Well, let's take a little bit of a detour here. I want to get to your concept of ready for sale because I really like that. But on the way to the sale, when somebody has a business and they're trying to develop and grow that business and they want to understand value, one of the things that comes into the context of that is the idea of a contingent event. And I suppose it's a risk, but there are certain foreseeable contingent events that owners have to look at.
Right?
Disability, death, burnout, withdrawal from the firm. I mean, we all know the list.
Yeah.
But your other book about buy-sell agreements is a great reference, and one of the things that businesses do have to look at is they may not be able to make the whole path. They may not be able to take the whole run and get to the point where they're ready to sell for maximum value. They may have something happen in between, and that something could completely wreck that planning. So I'm an advocate of the owners agreeing about that, putting something in place which has buy sell provisions in it. Do you recommend that kind of a buy sell plan for most private businesses?
If I say that every successful privately owned business, whether family owned or not, with uh, 2 or more shareholders should have a buy sell agreement. And that buy sell agreement should specify what happens if someone quits, is fired, dies, retires, disabled, all of those things. They're in the book. I've got like 40 different potential trigger events, not all of which are relevant for every business. But the thing of it is, if something happens and you don't have an agreement uh, about what's going to happen, you've got chaos. And you want to have a buy sell agreement, but you want to have a buy sell agreement that works and that will work if there's a trigger event. That's one of the reasons why I recommend what I refer to as a process called a single appraiser, select now, value now, and value regularly thereafter. In other words, pick the appraiser, let them value the business, make sure they have provided the kind of value you want. Did you want a discounted value? Did you not want a discounted value? But get those questions off the table and clarified right now, and then set the price for the buy-sell agreement based on that appraisal.
In your experience, Chris, do most businesses have these buy-sell agreements?
Many businesses have a buy-sell agreement of some form or another. Most of them won't work. Most of them won't. I'm having a call after our session today regarding a buy-sell agreement that called for the selling shareholder to select an appraiser, the company to select an appraiser, and then if they're not within 5% of each other, they'll select the third appraiser, and the third appraiser has got to be within 5% of one of the other two for there to be a conclusion. And if those three, none of the three are within 5% of each other, then they're going to do the whole process again. That is a faulty buy-sell agreement.
As an appraiser, though, that gives you a lot of work, doesn't it?
Well, uh, I used to say when I gave speeches to business owners that it's a good idea to get an appraisal every year, or at least every other year. And I said that 20, 25 years ago because I thought that would be really good for my business. Today, I say that unabashedly. I've been writing the same thing for a decade, that you ought to have a regular appraisal for your business because it's good for your business. Number one, go back to that concept of rate of return. The only way you can understand what rate of return you got from your business is through an appraisal process where you look at the appraisal, you look at the distributions, and you say, if my value went up 10% this year and I distributed 4% of value, my return was 14%. Well, 14%, that's a pretty good return. I can live with that. But if my value didn't go up and I didn't make a distribution, what kind of return did I get on that investment? Well, not a very good one. And if it were the guy's money manager, he'd fire him. But he didn't fire himself. But he's got to have that same concept of what kind of rate of return. We have a blog that I would advise or suggest that listeners go to. It's called the Family Business Director blog. And it talks about family business directors, but Travis Harms here is really talking to private business owners, whether it's a family business or not. And that's he comes out with a post every week, and they're really fascinating. So I'd recommend that some people take a look at that.
Yeah, I enjoy his posts, and they're normally the ones I've seen have been from a car. So he's posting from his car with some comments, but I found his comments to be very worthwhile.
Yes.
When we getting back to the buy-sell agreement aspect and creating a buy-sell, it's been my experience that one of two things happen. Either the owners can't get together, it's just too difficult to do the buy-sell. They can't have the conversations, they can't get it done. It's important but not urgent. It never reaches a priority, and like a lot of planning, they just don't do it. The other situation I see quite a bit is that they have hired someone in the legal business to provide them with, quote, an agreement. And that agreement hasn't really been vetted very well. And I know you've written a lot about those agreements and the need to really, what I call stress test them, but you really need to test the agreement to see if it works, and a very alarmingly high percentage of the agreements that are out there don't work. Right. So when you combine the situation where it's too difficult to do the buy-sell agreement, and you look at the groups that are out there that have ineffective or buy-sell agreements that do more harm than good, it's a huge problem for private businesses.
Well, it is, and I have a new book coming out. This was more toward attorneys, but it'll be good for financial planners. But what I'm offering in this book that's different than the book that we've been talking about is actual draft template language for the valuation portions of buy-sell agreements, so that that the language regarding the qualifications of the appraiser, for example, is clear. The language regarding the standards that the appraiser must follow is clear. The language regarding what kind of value it's going to be. Is it fair market value? Is it fair market value on a financial control basis? Is it fair market value on a non-marketable minority basis? Because this conversation I'm going to have in an hour or so, one of the appraisers read the buy-sell agreement and said the value should be discounted because it's not a controlling interest. And the other read the same agreement and said it's the fair market value of the company and did not take a discount. Well, you're not going to get within 5% if that's the case.
Well, let me pose a hypothetical of a situation where there is no buy-sell agreement. And let's say we've got a successful private business, and one of the owners is married and has expressed to his wife the thought that the business is worth $2 million. And that's just been incidental conversation. We don't have any documentation. We don't have a buy-sell agreement. And at some point, the firm acquires a buy-sell agreement which has certain provisions in it, and this owner dies. The other owner, exercising the buy-sell agreement, approaches the widow and says, we had this agreement, and I want to give you this $300,000 check for your deceased husband's share in the business. And she says, $300,000, I should be getting at least $1 million. And he said, who told you that? So the next day in her lawyer's office, she says to the lawyer, I've always understood the value of this business to be $2 million. I always see the lawyer at Seinfeld being the other lawyer. And he says, well, the business is worth $2 million. You should be getting $1 million. I'll take your case right away. And off we go. So how do we avoid that situation? What do we do to keep those things from happening?
Well, if we talk for several hours, I'll say the same thing several times. I've already said it once and I'm going to say it again. Put the buy-sell agreement so that there's a single appraiser where you select the appraiser now, you value the company now, and you value it regularly thereafter, at least every other year. Because if you do that, number one, you'll know what the value is for purposes of the agreement. Number two, you'll know what it is a year later for the agreement. Number three, you'll know what it is a year later for the agreement. And if that value was $4 million and not $2 million, I mean, it doesn't matter what someone said in idle conversation with his or her spouse. What matters is what the appraiser says. We value, I think, 125 or 30 companies every year. And we do that for, some of them are ESOPs, but many of them are buy-sell agreements, where every transaction that occurs in those companies, some of them are very substantial companies, every transaction that occurs at our appraised price.
Well, let me say that I hear you and I believe in what you're saying, so that you don't take what I'm about to say wrong. But if you have an appraisal every year, isn't that damn expensive for a business? I mean, to have to do an appraisal every year.
It's not nearly as expensive as the litigation you're going to have when you end up in a valuation dispute over a significant ownership interest. In my new book, it's my watch. The phone is off. It's my watch.
Oh, okay.
It's um, so, I made some calculations and said, okay, so the appraisal cost 10,000 a year, 20,000, whatever it is, and 10 years. We go out for any number of years, and you can have that stream of payments and have certainty of what's going to happen, and never worry about litigation. Or sometime down the road, there's a good chance you're going to have a dispute. And when you have a dispute, you're going to spend, collectively, you're going to spend a boatload of money. Well, the present value of that stream of payments is going to be less than the present value of the litigation because it goes on for a year or 2 years. So I don't, I mean, I understand it's expensive. It may seem expensive, but it's an operating cost of doing business. I mean, it's a cost of protecting your business and protecting your owners, and then providing the ability of your owners to plan.
Is there any cost benefit of doing it every year?
Well, if the way that I say it, uh, so that assume a hypothetical appraisal cost at $10,000, then probably 65 or 70% on the recurring. If it's 20,000, it'll be the same 65 or 70% because it's a reappraisal every time. Appraisers get in trouble trying to simply do a little calculation update for somebody because number one, it's not an appraisal and you can't rely on it. And number two, unless you go through the discipline of reappraising, you're going to miss most of the important changes in a business.
The the idea of getting that valuation information on a constant basis, an annual basis, is a great idea. And one of the things that I encourage business owners to do is manage for value, understanding those value concepts and managing the business so that the value goes up. It's an excellent guideline for management, and that unless you get a evaluation like that, you don't know where you are, and your own evaluation of how well you've done is suspect. We're all guilty of that. We're all human.
Rick, let me mention one thing to your listeners that may have a buy-sell agreement, and the company may have acquired life insurance in the event that one of the owners dies. Okay, the buy-sell agreement needs to be crystal clear as to how the proceeds of the life insurance policy are going to be used. They can be used as a corporate asset. For example, assume a company is worth $10 million and there's a $5 million policy on each of two 50% owners. Company's worth $10 million, one owner dies. Well, if the life insurance proceeds are a corporate asset, the company is now worth $15 million, and the dying shareholder should get $7.5 million. If it's a repurchase tool, then the life insurance sits over here and it buys the the stock, and then the company, when it's all said and done, is worth $10 million, and the remaining owner has a $10 million business, as opposed to a $7.5 million business. Now, which is right? Well, I will tell you that that's a big enough difference that if it's not crystal clear, there'll be an argument or potential litigation over it. And that's just a warning to any business owner or any attorney who has business owner clients who might be listening. Take a look and see.
Well, I think one of the things that anyone needs to do if they have a buy-sell agreement in place is stress test it and see if they really understand the provisions, see if the accountant that they work with understands the provisions, see if they understand the valuation concepts, and work through that unrelentingly, because as you say, it's the path either to weathering that contingent event or a lot of litigation and the possible end of the business endeavor?
Well, I have a buy-sell agreement checklist that would help a business owner or his counsel stress test a buy-sell agreement. And I'd be happy to provide it to you to provide to your listeners or readers or however you want to disseminate it.
We'll stick a link in the notes.
Okay,
Yeah, that'd be great.
I'll be glad to provide that.
Let's talk a little bit about someone who is seeing the benefit of managing for value and looking for that situation where they can actually pull the wealth out of their business with a great sale, the home run sale, the sale everybody thinks about. Uh, and How do you know what are the goals that you need to set up for yourself? Let's just say that your succession plan is in 5 years. We'd like to sell the business for as much as possible. How do you do that?
Well, number one, if that's your exit plan, then you better have a succession plan, a management succession plan in place. Because if you're a key person in a business and your relationships or your particular knowledge are essential to the business, then you better get that transferred. If your goal is to sell in 5 years, you better get those relationships and that knowledge transferred to other people so that the buyer comes in and the buyer understands that it's not dependent upon the owner. So there's an exit plan, and then there's a management transition plan that has to be in place as well. Because, you can think you're ready for sale, but if you don't have management transition in place, you're not going to get that top dollar sale.
Actually, the simple way to state that concept is really you can't sell yourself. If you have to cut a deal with somebody to stand for 2 years so the business can really run, then you've really undercut the value of that business.
Right. We had a management transition in 2009 where Matt Crow became president of Mercer Capital. I don't run Mercer Capital and have not run it since 2009 because I don't want the business to be dependent on me. I don't like to manage. So he's doing me a favor by taking care of that. And then I get to do podcasts and write books and work on projects that I like to work on. So it works pretty well. But your guy, if he wants to have the business ready for sale, needs to be thinking about, let's just say 5 things. Are risk. As you look at the business, what risks do you see? If this guy is a key person, then he is a risk and he is diminishing the future value of the business. If there are customer concentration risks, you want to be working out of those. If there are product risks, you want to be working out of those. If there are supplier risks, you want to be working out of those or doing your best to work out of them over time. But de-risk the company over time and always be looking at the company. Where do I see risk? Second, earnings. You got to have earnings. That valuation equation that we talked about, it says that value is a function of risk and earnings or cash flow and then growth. Well, let's focus on earnings. What are the margins in your business? Are the margins normal? Are they above normal? And if your margin is too big, then a buyer may not pay because he's concerned about a reversion to the mean. If your margin is below industry averages, you're maybe leaving something on the table and giving somebody else the opportunity to take advantage of that. So risk and earnings. I use A. I'm going to use ready, R-E-A-D-Y. But A is, I call it attitudes, and it's just a general word to say, are your people in place? Are they doing what they're supposed to be doing? Are you having good relationships with your customers? Are you having good relationships with your suppliers? But does the business have a good attitude, both internally and externally?
I like the attitudes, aptitudes, and activities. I like the AAA that you
Yep.
use.
Yeah. Uh,
Because the aptitude and the activities, that goes right in there. You
yeah.
know, it's one
Exactly.
thing to have an attitude, but if you're not executing, then
Yeah.
or you don't have the knowledge and the ability.
Well, but are your people in place and doing what they're supposed to be doing? Do they have
Exactly.
skills and training? I mean, that's if you've got a training issue with your people, and if you're in distribution or if you're in manufacturing, or and you have an error rate that is too high, that's a problem, and you need to solve it now, because that will be determined, that will be observed in due diligence by a buyer. So you want to solve that problem now in your 5-year plan. Now, uh, uh, drive D stands for driving growth. I couldn't get a G in ready. So, so if I have a level of cash flow, and say it's a 10% margin, and it's growing at 3%, that'll be worth one thing. If it's growing at 6%, that'll be worth more. Why? Because there's more dollars in the future that I can reasonably expect. So you want to be postured in a way that you have new products coming online, new services coming online, doing the kinds of things that you need to do to continue to drive growth. And driving growth can go into other things too. For example, customer retention. Uh, Many people don't think enough about customer retention, but it's much easier to sell the next project to an existing client than it is to get a new client. But think about there's customer turnover in every business. But suppose that my turnover ratio is, I lose 10%, my attrition ratio is 10% a year. Well, I've got to sell 10% just to break even, and I got to sell 15% to grow 5%. If I can cut the turnover to 95%, to 5%, and I can sell 15, I can grow 10. But attrition is normal in business, and uh, that's part of the growth strategy and the growth concept. And then finally, the why in Ready is, I call it year-to-year comparisons, because uh, our hypothetical owner is sitting here today and he wants to sell in 5 years. Well, what does he want the financial statements to look like to the buyer 5 years from now? Well, hopefully, I've had a fairly steady progression of revenue. I've had a fairly steady progression of earnings. I've got maybe improvement in margins. I've got a story that looks good to tell to that uh, avaricious buyer 5 years from now. That strategic buyer. Well, what your guy wants is not a strategic buyer. He wants an irrational buyer, but they're hard to find, particularly if you don't have a good story to tell. And so this concept of ready, I call it like putting on a pair of glasses, and when you look at your business, think about risk and earnings and attitudes and aptitudes and activities and growth, and what kind of story am I telling to prospective buyers in the look of my financial statements. And it takes a little thinking, but it's really a good way to look at a business.
I think one of the most helpful things that a business owner can do is get out of its own shoes and take the perspective of somebody else. We've talked about that with the idea of getting an objective appraisal every year, but also the idea of looking at the business from the perspective of a buyer. And one of the things that I often ask a business owner to do is to review a diligence checklist that buyers often go through in their due diligence to buy a business. And for any business that's been through that knows that that's a daunting task. It's a irritating, awful, detailed thing to look at. But if you're not ready, if you can't give those things to somebody who wants to know about them, then it's tough to say you're ready to sell. And in much the same way, when you come in to appraise a business, you're really asking a lot of the same questions. I need this information. I need that information. And if the answers you're getting is, well, I'm not sure, and we don't keep that, and I don't know where that is. I'll have to get the bookkeeper to. You already know
Yeah,
that there's a lot of work to be done. But that ready concept is a great guidepost and a way for a business to look at what they need to do to manage for value.
I think so. And like I say, I've given speeches and I put on a pair of glasses and say, ready right there. Because if you can think about that word when you're looking at a warehouse, for example, you can think about risk, or you can think about earnings and are there too many, are we properly staffed and that sort of thing. You can think about, are the people well trained? Are they doing what they're supposed to be doing and that sort of thing. You can think about, are we running the business to be able to grow? And what are the comparisons year to year or month to month or quarter to quarter for the performance of this warehouse? Because if this warehouse is performing well and the other warehouse is performing well and the other operation is performing well, then the consolidated is going to be performing well. So look at it through the eyes of ready.
The other great thing about that is it gives the idea of setting goals a built-in metric. We're talking about goals that we look at from year to year. If we're talking about progress, we're talking about things we can measure, we can get information about from an objective course from year to year. Then setting a 5-year goal, maybe we even know a number, maybe we even know how we want to do it. So it's extremely valuable. Uh, Chris, I want to thank you for joining us today. It's just been I knew it'd be good, but I've been delighted to listen to you say all the things that I try to tell business owners and try and get them interested in. I really appreciate it.
Well, I thank you for asking me to join you. It's been fun. I think maybe when the new book comes out, maybe you'll ask me back and we can talk about buy-sell agreements in a little more detail.
I'd be delighted.
Okie doke.
My blog is Owning a Business at owneragreement.com, and the business transition consulting website is btcllc.net. My website on managing for value is priordiligence.com. I have 2 books available on Amazon. Now What? The Practical Guide for Getting Maximum Value from a Business, and Implementing the Buy-Sell Agreement, an introduction to the implementation process, which creates wealth for you and your heirs. Chris, I really appreciate it, and I've enjoyed it, and I thank all of you for listening.